I don't think, as I said previously, I don't think monetary policy is probably the best tool in the eurozone to have a deep and sharp macroeconomic impact. But I don't think that an all-powerful central bank is the right answer. We need also to have at one point to get back to the pre-quantitative easing period, meaning that this is normal typically that Italy will pay a much higher premium than France or Germany. This completely makes sense. Otherwise, you don't have any incentive also to implement reforms.
More broadly speaking, you've been talking about some of the governance challenges in Europe. I've heard people speak about this who are quite knowledgeable, who seem quite pessimistic in some quarters about the ability of the European structural mechanisms of government to respond to these challenges. How serious is the governance challenge that the European Union and the euro area face right now? Are these existential challenges to those governance platforms?
Yeah, I mean, decision making at the European Union level, and we see even between member states, they don't share the same goals. I go quite often in Central Eastern Europe, and Hungary, which imports 90% of its energy, so it's very dependent, especially from Russia. Obviously, from a basic macroeconomic point of view, I understand why Hungary does not want to have tough restriction on Russia. But at the same time, you have some countries like France that want to move forward with green transition. I know that from abroad, France is very well known for its nuclear energy. But I want to highlight here that in 2017, France slowly decided also to move away from nuclear energy. On what they have done, bad policy decision, they wanted to channel investment in green energy, mostly solar and wind. It was again a mistake. And nowadays, what we see is that half of the nuclear reactors in France were shut down because they did not invest enough to take care of the infrastructure. So I think at the European Union level, between the member states, there is no unity regarding what they want in the next month, next quarters, in terms of energy policy. And this is a shame because I think we are facing everyone, all the world, a tough situation. But the biggest problem of the European Union, they have been created by bad policy choice mostly. Because the biggest problem is the energy crisis. You don't have the same situation in Asia, in the United States. We created our own structural issues at the moment.
Yeah, and as with energy policy, so too perhaps with economic policy. You talk about this misalignment, this view from within different nation states of different goals, different policy outcomes that are being pursued, and the challenges that creates. One could say that that's analogous in many ways to what's happening from an economic perspective, from a central banking perspective, because you have different economies operating at different speeds, essentially locked into the same interest rate policy and broader monetary policy for those countries. Talk a little bit about where the ECB plays a role in this. Obviously, it's a significant one in terms of determining economic output, managing those key variables like price stability and employment within the euro area.
Yeah, I think this is a very strong point because if you look at the tough challenge for the ECB is that you have plenty of countries, plenty of fiscal policies that are different from one country to another, but at the same time, you need to have a common monetary policy. But when you look at all the economic data, typically look at inflation. I think the lowest inflation rate is in Malta currently, which is around 5.5%. And you have some countries that are at double-digit inflation. So how do you manage the situation? On top of that, of course, you have various levels of unemployment. Some countries, like in Italy, they are in like in Germany, they are facing full employment. Others, much higher level of unemployment, especially Spain, Italy. So for the ECB, at the end of the day, the ECB will always fail because the major macroeconomic and fiscal difference that are between each countries that are part of the eurozone, you cannot manage this situation. You cannot navigate within this situation. Some countries, they will need much accommodative monetary policy because they need also lower interest rate. Think Italy, of course, but some other countries, they need much tougher and restrictive monetary policy. Think Germany, where inflation is above 10%. So for the ECB, what they are doing, they are playing the basic playbook that we have at the aggregate level, a high level of inflation, yes, but some countries actually, when you have only 5 or 6% of inflation, this is comparatively high compared to the pre-COVID period, but still, perhaps you don't need to have so high interest rates. So at the end of the day, I think monetary policy can only fail in the eurozone because the structural difference of the economy are way too big at the same time. So this is not like in the US, because I know from the European side, we sometimes when we say yes, but from countries to countries, the situation is different. Like in the United States, if you go from one state to another, but at the end of the day, you have basically a more common fiscal policy. Some countries at the European Union level, they have a very strong fiscal stimulus. France was one of them. In October 2021, they started to subsidize the energy bill. Germany took much longer to do that. So this is impossible to navigate in such a situation. And that's why I think the monetary policy at the Eurozone level is at the end always a failure. What the ECB can do is quantitative easing. We know it works. It lowers interest rates. This will work. No issue. But from a macroeconomic point of view, to stimulate the economic activity or to lower inflation, I don't think monetary policy is the right tool, especially in the Eurozone, because the situations are way too different from one country to another.
Those are such important points and so well framed as we have this discussion. One of the things that caught my attention, I believe it was at the last ECB policy meeting, there was a release about something called TPI, the Transmission Protection Instrument, that perhaps I'm misreading this, and I don't want to overstate the case. But when I read the release that came out from the European Central Bank, it said essentially that the European Central Bank has the authority to do two things. First, unlimited spread control, meaning that they have the right to intervene in sovereign debt markets, essentially to normalize interest rates across different nation states that have very different economies and therefore get priced very differently by markets, should they feel the need to do so. And the second point that I took from the TPI data release was that they had the ability to do unlimited yield curve control, meaning they had the ability essentially to buy sovereign debt at any point in the yield curve. And to me, those were pretty considerable statements in terms of the mandate, the expansion of mandate that the ECB took with that statement. Was I misreading that?
No, not at all. I mean, I remember when I read the statement, I was amazed because basically what I understood is what you perfectly framed, is you have an all-powerful central bank that can step in on the market whenever they want, basically. I mean, of course, they will find a good reason, but you can always find a good reason to step in the market. Let's say you have an election in Italy. Of course, the spread will increase. This always happens. We always know that. So I was a bit puzzled, and I don't think, as I said previously, I don't think monetary policy is probably the best tool in the Eurozone to have a deep and sharp macroeconomic impact. But I don't think that an all-powerful central bank is the right answer. We need also to have at one point to get back to the pre-quantitative easing period, meaning that this is normal typically that Italy will pay a much higher premium than France or Germany. This completely makes sense. Otherwise, you don't have any incentive also to implement reforms. I don't say this is easy, and I am not a big fan of structural reform because I don't think it always works. But still, you need to reform the country, and you need to have this, I think, this incentive coming from the market also to do sometimes the right thing. And frankly speaking, I was puzzled when I read the statement. I did not understand. I don't think I was the only one, because the message they send is that they will anyway, they will become kind of a market player on the bond market whenever they want. They will control the bond market. This is a kind of nationalization of the sovereign bond market, and this is not healthy for the economy as well.
Yeah, and according to the statement, they have the ability to do so at unlimited scale. It's fascinating to me because I speak to people here in the US, many of whom follow financial markets very closely, and very few people who I know in the United States have heard of the transmission protection instrument, let alone understand its implication. You said something that I thought was very profound. You said that in many ways, monetary policy is not the best tool to deal with this, but sometimes the challenge is it becomes the only tool when there are crises, when there are moments where there needs to be intervention. Central banks are kind of like the police department. They're the only people who pick up the phone at 2 o'clock in the morning when there's a problem. Whether or not that is necessarily the best suited policy solution. Talk a little bit about the risks of policies on this scale and what it might actually mean for real economic growth and indeed in things like variables like employment and price stability in Europe.
Well, I am kind of old-fashioned economist in the way that I agree that central banks need to step in, and sometimes we need also to contain speculation on the market. This is not always healthy, and from time to time also, I remember a few years ago when you had a lot of speculation against Italy, it was not healthy, and it was the right moment for the ECB to step in. But at one point, when you have this central bank that is low, basically because it intervenes a lot on the market, lowering the cost of capital, lowering interest rates for government. You don't have incentive to reform. You have also all the zombie companies that are still part of the market. I think we should not always look to avoid an economic crisis. I think economic crises are also healthy at one point. This is a normal part of the business cycle. This should happen. I remember I was much younger, but in 2008, 2010, when we decided, especially in the European Union, that we will save all the banks, no matter the cost. Of course, systemic banks, and this I understand perfectly, but also even smallest bank. This is not healthy. We need to understand that if you take a risk as a private actor, even or as a public actor, you need to pay a premium. It can be bankruptcy, it can be higher interest rates if you want to raise capital, and this kind of thing. But we cannot have an economy under the control of central banks forever. Just one figure that matters for me. Since the latest tightening cycle, so only a few years ago, we had an accumulation of public and private debt, which is around $800 billion. So the situation of having for such a long period of time low interest rate means at the end of the day, much more debt. And I am not someone that believes that if you have the level of debt at 100, public debt at 100% of GDP, this is bad, or this is at 90 or 80. I think we don't really know exactly how the market will react, and it depends from one country to another. But I don't think this is healthy for the economy to open up this channel of huge amount of debt. I mean, in just a few years, so much debt, this does not make sense. And it's mostly due because we know that we have central banks at the end of the day. So it does not matter. The same thing for private companies. I was looking at the Paris stock market. You have 70 companies, like mostly small companies, but still listed companies on the stock market that are basically, I mean, they should go bankruptcy if you look at what their business model, the market reaction on anything. But they still can borrow cheap money because the European central banks maintain this level of very low interest rates. So I believe that not so much in creative destruction. I think most of the time always come up with that, but this is basically this idea. We need to have crises. This is part of the business cycle. We need to have bankruptcies of companies. And at the end of the day, we will have much stronger economic activity. Look at productivity. Look at GDP growth, potential GDP. What did it bring to have more than 1 decade of low interest rates? Nothing good. Productivity is still getting down. Potential GDP, we still don't have the exact figure for post-COVID area, but it won't be very nice. It will be extremely low. So at one point also, we need to price much better the risk. That's why I'm not in favor of quantitative easing forever or central banks doing some kind of monetary financing of the economy.
Hey there, revolutionaries. To join a community sharing professional insights like what you just watched, head over to realvision.com and get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Join our community of lifelong learners.